Please like, share, and subscribe. Wishing you happiness and good luck every day.
You've probably heard of Seth Klarman's margin of safety. It's become a legend in the investing world. It's famously out of print, and a used copy can sell for literally thousands of dollars. So what's the big deal? Well, it's not because there's some secret formula inside. It's because it offers a timeless philosophy on how to think and act in the middle of all the market chaos. This is not a get-rich-quick book. It's a playbook for the thoughtful investor. And right from the get-go, Klarman does not pull any punches. He immediately reframes the entire stock market with one powerful metaphor. He says, forget what you think you know. Wall Street isn't some noble marketplace of ideas. It's just a gigantic casino. Now, you might think that's cynical, and maybe it is, but Klarman argues that really getting this idea is the absolute first step if you ever want to find a better way to invest. All right, so here's our game plan for breaking this down. First, we're going to step into what Klarman calls the Wall Street casino to really understand the game. Then we'll look at where most players go wrong. After that, we'll explore a different way, the value investor's path, and get into the most important rule of the game, the margin of safety. And we'll wrap it all up by seeing why this is really a philosophy, not just some cookie-cutter formula. Okay, let's get into it. Section 1, the Wall Street casino. You know, Klarman's whole point is that before you can even think about winning, you have to truly understand the game you're playing. And it's a pretty chaotic one. So what does he actually mean by a casino mentality? Well, think about it. A casino doesn't really care if you win or lose, right? They just want you to keep playing. Klarman says Wall Street is the same. The whole system is built to prioritize the volume of transactions, just making trades, over any real useful economic purpose. Why? Because they get a cut every single time a trade is made. And this leads to managers frantically trading long-term assets like they're hot potatoes. Billions of dollars are just thrown around based on what's trendy, with almost no thought given to the actual business behind the stock. And the fuel for this whole fire? It's that classic, powerful temptation of making a fast buck. All right, Section 2, where most investors stumble. So if the market really is a casino, well, it's pretty easy to see how people can get into trouble. In fact, Klarman says we often become our own worst enemies. Let's look at the traps he points out. Klarman draws a really clear line in the sand here. He says you're either doing one of two things. On one side, you have true investing. That's a real strategy, a disciplined process. You're in it for the long haul. On the other side, you've got speculation. And to him, that's just straight up gambling. It's all about the thrill of a quick and easy win with no real substance behind it. And what's driving all this speculation? Well, it's the two big ones, greed and fear. When the market's going up, it's pure greed. People get swept up, they start making crazy bets, and they totally ignore the risks. But then the market turns. And what happens? Fear takes over. Everybody panics. They start dumping perfectly good investments at bargain basement prices, usually right at the bottom. It's this vicious cycle that just destroys wealth. So what's the result of all of this emotional whiplash? Klarman has a great term for it. The relative performance derby. Basically, a lot of professional money managers aren't actually trying to make the most money they can. No, their main goal is to just not look bad compared to everybody else. They don't want to be the one who misses out on the hot new thing. And what does this create? A massive herd mentality. Everyone ends up chasing the same fads, and the focus shifts from long-term business value to just, what's the stock price going to do tomorrow? Okay, that brings us to Section 3, the value investor's path. So, we've seen the problem, right? This emotional casino. Now, let's talk about the solution. Klarman's disciplined, rational alternative to all that madness. It really comes down to this. You have to choose a side. The wrong choice? That's the emotional path. You're focused on the short term, you treat stocks like just pieces of paper to be traded back and forth, and you're always trying to guess what everyone else is going to do. The correct choice, according to Klarman? That's all about fundamental analysis. You're committed for the long haul, and, this is key, you see stocks for what they actually are, a piece of a real, living, breathing business. So what is value investing, really? Klarman's definition is beautifully simple. It has zero to do with trying to predict what the market's going to do next week or next month. It's a two-step dance. Step 1, you do your homework. You figure out what a business is actually worth, its assets, its earnings, all that good stuff. Step 2, you wait. You patiently wait until you can buy a piece of that business for way less than what you think it's worth. That's it. That's the whole game. You see how this just completely flips the script, right? Your number one goal isn't how much money can I make anymore? It's how do I not lose money? It's all about the preservation of capital, defense first. And the biggest challenge? It's not about being a genius stock picker. It's about discipline and patience. It's having the strength to just sit and wait for a good pitch. You buy when things are cheap, you sell when they're not, and you put on your noise-canceling headphones to ignore that whole short-term performance derby. All right, section 4. This is the big one, the margin of safety. This is truly the heart of the entire book. It's the absolute bedrock of Klarman's philosophy. If you want to know how to protect your capital, this is it. So what is a margin of safety? Think of it like a shock absorber for your car, or a safety net for a trapeze artist. It's a buffer. It's the discount between the price you pay for something and what it's actually worth. It's your cushion. A cushion for what? For bad luck, for when you make a mistake in your analysis, and you will, and for the simple fact that the future is messy and unpredictable. It's a way of humbly admitting, hey, I don't know everything, and I could be wrong. And why is this so important? Well, Klarman boils it down to 3 fundamental truths. Number 1, trying to value a business isn't an exact science. It's an art. It's always going to be a little fuzzy. Number 2, nobody can predict the future, period. And number 3, you're human. I'm human. We all make mistakes. So the margin of safety, that's your protection against all 3 of those unavoidable realities. And this right here, this is what separates the value investors from everyone else. It's not about having a higher IQ. It's not about having some secret inside scoop. Klarman is crystal clear on this. The single biggest thing that defines a value investor is their relentless, almost obsessive focus on demanding a margin of safety. That's the dividing line. Now, it's super important to understand this is not a get-rich-quick scheme. Not even close. When the market is booming and everything is going straight up, value investing can actually look kind of boring. You might even lag behind the hot stocks for a while. But that's not when it's supposed to shine. Its real power comes out in a downturn. When things get ugly, that's when your margin of safety kicks in like a financial airbag. It protects your capital while other people are getting wiped out. It's a strategy built for survival. And in the long run, survival is how you win. And that brings us to our final section, a philosophy, not a formula. Because at the end of the day, Klarman's biggest lesson isn't about some specific technique you can learn. It's a whole way of thinking. It's much more about your temperament than your spreadsheets. This quote from Klarman himself just nails it. He's not giving you a fish. He's teaching you how to fish. He's not telling you what to buy. He's teaching you a way to think about buying anything. He's giving you a framework to stay rational when everyone around you is going nuts. And let's be honest, that's way more valuable than some hot stock tip that's going to be useless next week. But let's be real, this is not the easy way out. Not at all. It takes a ton of hard work to actually value a business properly. It takes what Klarman calls unusually strict discipline to say no to all the temptations out there. You have to be willing to think in terms of years, not months. And most of all, you need the right mindset to stay calm when the world is freaking out. You know, Warren Buffett talks about this too, and he says something really interesting. He says value investing isn't something you just kind of pick up over time. It's more like a switch flips in your brain. It's a total paradigm shift. You either get it and it clicks all at once, or you never really truly get it. And that's what happens when that switch flips. Klarman says once you really embrace this way of thinking, you look at the rest of the market and it just looks like gambling. That's all you can see. It completely and permanently changes how you view risk and reward. So we've come full circle, right back to you, the investor. The biggest hurdle in all of this isn't how smart you are. It's about your temperament. It's about your character. Can you stand alone when the crowd is running in the other direction? Do you have the patience to do nothing for long stretches of time? And can you stick to your guns even when it feels like you're the only one in the world who thinks you're right? That's the real test. And that really leaves us with one final crucial question. This isn't about the market, it's about you. Klarman basically forces you to look in the mirror and ask yourself a tough question. Forget the spreadsheets and the analysis for a second. Do you, personally, have the discipline it takes to be a true value investor? Because that, right there, is the whole ball game. Welcome to The Explainer. Today, we are tackling a question that is absolutely fundamental to your financial life. What is the real difference between investing and speculating? You know, getting this right can be the one thing that separates long-term success from everything else. And Mark Twain just hits the nail on the head here. He's basically saying that speculation is a game you're just not meant to win, no matter how much money you have. So if we're supposed to stay away from it, we'd better know exactly what it is and what it looks like in the wild. So here's how we're going to break this down. First, we'll draw a really clear line in the sand between an investor and a speculator. Then we'll dive into a kind of strange but brilliant story about sardines that shows you the speculative mind at work. After that, we'll meet an imaginary business partner who can help us make sense of the market's chaos. And finally, we'll tackle the biggest hurdle of all, our own human psychology. Okay, let's get right into it. On the surface, an investor and a speculator might seem like they're doing the same thing, right? They're both buying and selling stocks, but underneath, their entire worldview, their mindset, it's like they're from different planets. And this right here, this is the whole game. An investor looks at a stock and sees a tiny piece of a real company, a business that makes things or sells services. Their decision to buy is all about, is this a good business, and am I getting it at a fair price? The speculator, they see a ticker symbol, a piece of paper. Their entire strategy is based on guessing which way the price will wiggle next. The actual business, it's almost an afterthought. It's all about the price. Now, to really hammer this point home, I want to tell you a story. It's an old Wall Street legend, but honestly, its lesson is more relevant today than ever before. So, picture this. The sardines have suddenly disappeared from the waters off Monterey, California. There's a huge shortage. All of a sudden, commodity traders are in a complete frenzy, and the price for a single can of sardines just goes through the roof. Everybody's piling in, buying up cans, not because they're planning a big dinner, but because they're absolutely convinced the price is going to be even higher tomorrow. Okay, so one of these traders, who's just paid a fortune for a can of these very special sardines, decides, you know what, I'm going to open this up for lunch. He takes one bite, and he gets violently ill. The sardines are disgusting, totally inedible. So he marches right back to the guy who sold him the can, and he is furious. And here's the kicker. The seller just looks at him, totally calm, and says, "You don't understand. These aren't eating sardines. They're trading sardines." And in that single sentence, the entire game is just laid bare. The price of this thing had become completely disconnected from its real, useful value. Nobody gave a darn if the fish were rotten. All that mattered was that the price was going up. You see, the sardine story is really a perfect metaphor for what's called the greater fool game. That's the whole strategy of buying something you know is overpriced, with the hope that you can find an even greater fool to sell it to for even more money. The obvious problem, of course, is that sooner or later, you run out of fools. And listen, don't think for a second this is just a funny old story. This happens constantly. In 1983, the market for Winchester disk drive companies was bid up to a crazy $5.4 billion before it all came crashing down. In '89, people were paying more than double the actual value for shares in something called the Spain Fund, just gambling that someone else would pay more later. Heck, even a 30-year treasury bond can become a trading sardine. Speculators were holding them for on average just 20 days, betting entirely on which way interest rates would twitch. So if just following the herd and chasing prices up and down is speculation, how is an investor supposed to deal with all this volatility? Well, let's introduce you to your new, very eccentric business partner, Mr. Market. The investing legend Benjamin Graham came up with this brilliant idea. He said to imagine the stock market as a person, Mr. Market. And this guy is your business partner, but he's completely manic depressive. Every single day, he shows up and names a price. Some days he's euphoric. I'll buy your shares for way more than they're worth. Other days, he's terrified. Please take my shares. I'll sell them for next to nothing. The key thing to remember is this. He's there to serve you, not to guide you. And this is where you see two totally different reactions to the exact same event. Let's say Mr. Market is having a meltdown and prices are plummeting. The speculator panics. They think, oh my God, Mr. Market must know something I don't. I gotta get out. So they sell. The investor sees the exact same low prices and thinks, my homework says this is a great business. Mr. Market is basically putting it on sale for me. One sees a disaster, the other sees an opportunity. So the investor has a process, a disciplined playbook. When the market is going haywire, they don't freak out. Step 1, ignore the noise. Mr. Market's mood swings don't tell you anything about the business itself. Step 2, calmly reassess the actual value. Has anything fundamentally changed about the company? And step 3, if the business is still solid but the stock price is in the gutter, you recognize that for what it is, a bargain. You have to look past the price to the value. All right, so now we have the right mental framework. We know we should think like a business owner and use Mr. Market to our advantage, but now comes the really hard part. Seriously, it has nothing to do with math or economics. The single biggest obstacle to being a successful investor is you. It's managing our own emotions. Greed is an incredibly powerful force. It's that little voice that whispers, "Get rich quick." It's what makes us chase after hot stock tips without stopping to think, wait, why is this person telling me their billion-dollar secret? It leads us down the path of new era thinking. You know, when we convince ourselves that the old rules of value don't apply anymore because this time is different. And it causes us to do something really dangerous called reaching for yield, taking on all sorts of hidden risks just to squeeze out a tiny bit more return. And this slide is a perfect example of that reach for yield in action. Back in the 1980s, investors who were desperate for high returns were called yield pigs, and Wall Street was more than happy to serve them a risky menu. You had junk bonds, which promised a high yield but hid the very real risk you could lose all your money. You had these option income funds that were basically just giving you your own investment back and calling it yield. And you had people stampeding into an expensive stock market simply because safe-old bonds weren't paying enough. You know, the same desire for an easy way out also sends people looking for some kind of magic formula. Like, oh, I'll just buy stocks with the low price-to-earnings ratio. The problem with that is it's like trying to drive a car by only looking in the rearview mirror. A stock often has a low PE ratio for a very good reason, because the market is correctly guessing that its profits are about to fall off a cliff. There's just no simple, backward-looking formula that works. And really, that brings us right back to where we started. This distinction we've been talking about, it's not just a small thing, it is everything. So the next time you're about to buy a stock, or any asset, I want you to stop and ask yourself this one simple but powerful question. Am I buying a piece of a real business that I understand? Or am I just buying a trading sardine and hoping that a greater fool is just around the corner? The answer to that question will define your entire financial future.
Welcome to The Explainer. You know, have you ever had that feeling that the whole financial game is, well, rigged? Today, we're going to dig into why that feeling might actually be spot on. We're about to pull back the curtain on a really fundamental conflict right at the heart of Wall Street, one that could be costing you real money, maybe without you even knowing it.
This quote, man, it just gets right to the core of the whole thing. The people you trust with your money, right? Your broker, your fund manager, they're often playing a totally different game than you are. And it's not that they're bad people, not at all. It's that the system they're in, it gives them incentives that are often the complete opposite of what's best for your long-term success.
So here's our game plan for this explainer. We're going to start with that core conflict, then we'll see how the whole fee structure drives everything. We'll look at how that plays out with new stocks and those crazy market fads, and then most importantly, we'll wrap up with what you can actually do to protect yourself.
Okay, let's dive right in. The heart of this entire issue is this fundamental conflict of interest. Seriously, just understanding this one thing is your first and maybe your most important line of defense as an investor.
So here's the bottom line. Wall Street makes its money from activity. They get a paycheck when a trade happens or when a new stock gets sold. And that right there creates this natural conflict. See? Their goal is the transaction itself. Your goal is the long-term success of that transaction. They get paid right now. You just hope to get paid way down the line.
So what's really at the root of this conflict? Well, it all comes down to one simple, incredibly powerful thing: how Wall Street gets paid.
And here it is, the one concept that changes everything: upfront fees. Just think about that for a second. Your broker gets paid for making a trade. It doesn't matter if that trade makes you a fortune or loses you everything. The entire system is set up to reward activity, not successful outcomes for you, the investor.
This slide just lays it all out, doesn't it? It's crystal clear. You're on this long journey trying to build wealth over time. But for a lot of folks on Wall Street, the main goal is just to keep that fee machine humming. This massive disconnect is what leads to huge problems, like brokers trading your account way too much. That's called churning. Or pushing you into products that just happen to pay them the highest commission, not the ones that are actually the best fit for you.
All right, now let's look at where this fee-driven model gets put on steroids: the world of new stocks, also known as IPOs. This is where that conflict of interest becomes incredibly powerful and really, really expensive for investors.
Just take a look at the numbers here. I mean, the difference is absolutely staggering. A broker can make so many times more money selling you a brand new stock than they can from a regular everyday trade. So when the financial incentive is that lopsided, you have to ask yourself, is my broker recommending this because it's a truly great investment? Or is it because it's a fantastic payday for them?
And here's why that's true. When a new security gets created and sold, the people on the other side of that deal,
The company issuing the stock and the big investment bank running the show, they have all the advantages. They know way more about the business than you do, and they have complete control over when to sell it and what price to ask. You, the buyer, you're walking into that deal at a huge disadvantage from the very start.
This slide shows a classic trap in action. So, you put in $10 for one share, boom, right off the top, a massive 8% commission gets taken out. So only $9.20 of your money is actually working for you. Then, almost like clockwork, the fund's price in the market drops below even that 92. The result? You're instantly down 10, maybe 15%, while the folks who sold it to you are happily counting their fees.
Okay, so beyond just the fee structure, there's another much broader issue at play. The entire financial system is built with a bias toward optimism. Almost everyone involved, from the brokers to the companies themselves, makes more money when the market is going up.
Just look at this list of who benefits from a rising market. It's everyone. Wall Street firms get more deals and more fees. Stockbrokers get bigger commissions from happier clients. Companies can raise money more easily. We investors feel great watching our portfolios grow. Even the regulators are happy because it looks like everything's stable. With literally everyone pushing in the same direction, it creates this powerful, system-wide pressure for prices to only go up.
And this bullish bias isn't just a vibe or a feeling. It is literally written into the rules of the game. As you can see here, buying a stock is simple. It's an open road for anybody. But what about betting against a stock by selling it short? Well, that road is filled with roadblocks and restrictions. This is no accident. The system itself is engineered to make it much, much easier for stocks to go up than to go down.
And here is another crystal clear example of that built-in bias. After the big crash in 1987, they put these rules in place called circuit breakers to stop all trading if the market drops too fast. But notice something. There are no circuit breakers for when the market shoots up too fast. The rules are designed to stop panic selling, but not panic buying. It is an uneven playing field that clearly favors the bulls over the bears.
So, what do you get when you combine a fee-driven machine with a built-in bullish bias? You get fads, lots and lots of fads. Wall Street knows that new and exciting are incredibly easy things to sell, so it is constantly inventing new, often complex products just to generate a fresh wave of fees.
This line is just brilliant. It means that investors get so swept up in the hype of a hot new trend that they end up paying a price for a trendy, short-lived business, like Cabbage Patch Kids were, that would only make sense for a super durable, dominant company like Coca-Cola. They mistake a fad for a permanent franchise.
The Home Shopping Network is the perfect case study of this. Back in the 80s, the hype around this new way of shopping was off the charts. It pushed its value to over $4 billion. The story they told was all about tremendous growth. But that optimism, it was massively overblown. Just 1 year later, the stock had crashed by over 90%.
And here is the absolute key takeaway about all these fads. The cycle is predictable. When an idea gets hot, Wall Street basically turns into a factory, just churning out as many related products as it possibly can to meet all that investor demand. And they keep producing and producing until supply finally overwhelms demand. That exact moment, when there's just no one left to sell to, that's the peak, right before the crash.
So after hearing all this, you might be thinking, how on earth can I possibly win? And that's exactly what this final section is all about. The goal isn't to avoid the system completely, but to learn how to operate inside of it safely and successfully.
It really all comes down to these 4 principles. First, always be on guard. Remember, their motivation is not your motivation. Be skeptical, really skeptical of every single pitch. And maybe most important of all, be self-reliant. Because at the end of the day, your financial success is your responsibility and yours alone. You have to be your own strongest advocate.
So, we'll leave you with this to think about. The whole point of this explainer isn't to scare you or make you give up on investing. It's to make you a smarter, more aware investor. So now that you know the real rules of the game, how are you going to play it differently? Thanks for watching.
Okay, let's get right into it. We are about to pull back the curtain on the world of professional money management. And what you'll find is that it's this incredibly high-stakes game where trillions of dollars are in play. But, and this is the crazy part, the game is often rigged against the very people it's supposed to be helping. It's what's called the institutional performance derby, where the real goal isn't always to win, but to just not lose your job.
And just to get a sense of the scale we are talking about here, let this number sink in for a second.
By 1990, professional institutions were managing a staggering $6 trillion. This wasn't just a little bit of growth. This was a complete power shift that fundamentally rewired the entire financial market. It went from a place where you and I, individuals, own stocks to a market totally dominated by these massive, faceless firms.
And that leads us to the big question, right? The central puzzle we're going to dig into. These institutions, they have virtually unlimited resources. They hire the absolute brightest minds from the best universities. They have access to data and computers we can only dream of. So why, with all of that firepower, do their results so often range from just meh to downright terrible? That's the mystery we are unpacking.
So, here's our roadmap. First, we're going to explore this paradox of how these giants got so powerful in the first place. Then, we'll follow the money to see how their whole incentive structure is just fundamentally flawed. We'll see how that leads to this bizarre race to average, which then pushes them toward investing on autopilot. And then, we get to the good part. The silver lining, the surprising opportunities all this weird behavior creates for the rest of us.
All right, let's jump into part 1, the institutional paradox. To really understand the problem today, we have to go back and see how these titans of finance even came to be. What's so wild about this is the sheer speed of the growth. It was just explosive. After World War II, you had pension funds and retirement savings just swelling up, and this whole new industry popped up to manage it. So you go from a respectable, $100 billion in 1950 to an almost unbelievable $6 trillion just 40 years later. That's not a line on a chart. That is the financial equivalent of a supernova.
And that supernova completely changed the gravity of the market. Institutions went from being these small fish in a very big pond to literally becoming the pond itself. Just think about that for a second. By 1990, they own almost half of all U.S. stocks and were responsible for 3 out of every 4 trades made. And this is so crucial because it means their behavior, their biases, their weird rules, that's what dictates the entire market now. It affects every single one of us.
Okay, so let's move on and see where the first big crack in the foundation appears. It turns out the business model itself creates this huge fundamental conflict. See, to get why institutions act so strangely, you have to first understand how they get paid.
So here's the thing. It all comes down to this deep structural conflict of interest. A manager's paycheck is almost always tied to a tiny percentage of the total assets they manage, what's called AUM. So their main business goal is to make that AUM number bigger, to gather more assets because that directly increases their fees whether they invest well or not. The client's goal? Well, that's obvious, to get the best possible return on their money. And these two goals, they're not just different, they are often pulling in completely opposite directions.
And this quote just brilliantly illustrates the disconnect. It's the classic skin in the game problem, right? I mean, if a chef won't eat their own food, you'd be pretty suspicious. And yet, so few institutional managers have a really meaningful amount of their own money invested in the funds they run for other people. When they don't eat their own cooking, their focus naturally shifts from what's best for the client, performance, to what's best for the firm, gathering more assets.
This idea is captured perfectly by something called the tremble factor. Think about it. The Roman engineer who built an arch had the ultimate skin in the game. He had to stand under it. His personal safety depended entirely on the quality of his work, and that created this intense, personal focus on getting it right. But for a money manager whose personal fortune is safely tucked away somewhere else, that tremble factor is just gone. The fear of personal loss gets replaced by a more bureaucratic fear, the fear of looking bad compared to your peers.
So if the incentives are fundamentally all wrong, how does that actually warp their behavior day to day? Well, that brings us to our third section, what we're calling the relative performance derby, a really bizarre race where the goal isn't to be a visionary winner, but just to be an acceptably mediocre loser.
This idea right here, this is the key to the whole puzzle. Instead of asking the most basic investing question, hey, is this business a good value and is it likely to grow? The institutional manager is forced to ask a totally different set of questions. How did I do this quarter compared to the S&P 500? And how do my numbers look next to my competitors? Suddenly, success isn't about generating great returns. It's about not straying too far from the benchmark or the rest of the herd.
And what this does is it transforms investing from a careful analysis of businesses into a wild guessing game. You're no longer trying to figure out what a company is actually worth. Nope, you're trying to guess what everyone else is going to think it's worth in 3 months. It becomes this game of second and third guessing mass psychology, just trying to get a step ahead of the herd before it stampedes.
And here is the cold, hard career logic for a professional money manager. If you buy the same popular, big-name stocks as everyone else, you're pretty much guaranteed to get average, mediocre results. And in the institutional world, you know what? Mediocrity is safe. You get to keep your job. But if you dare to be different, if you buy some unpopular stock and it takes a little while to pay off, your short-term numbers will look terrible. And that becomes unacceptable. And you risk getting fired long before you're ever proven right.
This intense pressure, this career-driven need to conform, has led so many institutions down a really dangerous road. They've basically given up on the hard work of thinking and just outsourced their decisions to supposedly foolproof formulas and autopilot strategies.
Back in the 1980s, one of the most popular of these magic formulas was called portfolio insurance. And the theory was, well, it was really seductive. You use these fancy computer models to automatically sell stock futures anytime the market takes a dip. This was supposed to create a floor for your portfolio, protecting you from big losses. It was the holy grail. You get market returns on the way up, but you have limited risk on the way down. I mean, what could possibly go wrong?
Well, on October 19, 1987, theory collided with reality. Hard. A falling market triggered all the sell programs, just like they were designed to do. But here's the problem. Because so many institutions were using the exact same formula, they all tried to sell at the exact same time. And that unleashed this massive flood of sell orders, which created a terrifying feedback loop. The automated selling pushed futures down, which forced traders to sell actual stocks, which drove the market even lower, which triggered even more automated selling. The insurance became the gasoline on the fire.
So, with these complex strategies like portfolio insurance literally blowing up in their faces, institutions ran to what seemed like a much safer autopilot strategy: indexing. And you can see the appeal, right? I mean, look at this. During the 1980s, the simple act of just owning all the stocks in the S&P 500 would have beaten the average professional manager most of the time. The logic became brutally simple. If you can't beat them, join them. Just buy the whole market, and you're guaranteed to never look bad.
But this is where you see the sheer absurdity of just mindlessly buying stocks without any thought to their price. This number, $155 million, that's how much Blockbuster Entertainment's market value went up in a single day. Was there some amazing news about the company? Did they cure a disease? Nope. It was simply the day that Blockbuster was added to the S&P 500 index, so hundreds of index funds were automatically forced to buy its stock, no matter the price, creating this huge artificial demand that had absolutely nothing to do with the company's real value.
And this right here, this exposes the big central contradiction of indexing. The whole strategy is basically a free ride. It only works because it assumes that the market is mostly efficient, that prices, accurately reflect value. But that efficiency only exists because there are a ton of active investors out there, doing the hard, expensive work of researching companies and setting those prices. The more people who give up and just become passive indexers, the fewer people are left to actually make the market efficient in the first place, and that creates more and more pricing mistakes.
So, we've seen the messed up incentives, the herd mentality, the flawed autopilot strategies. After all that, what is the big takeaway? Well, this is where the story pivots, because all of these institutional flaws, they create a massive opportunity for the individual investor. And Warren Buffett just nailed this idea perfectly. The entire institutional world, with its obsession with relative performance and its move to indexing, has pretty much convinced itself that trying to beat the market is a waste of time. They've been taught that it's useless to even try. So for any investor who is actually willing to try, to do the work and think for themselves, this is an unbelievable advantage.
So the crucial point is this: every single institutional weakness can be an individual's strength. You are completely free from that crazy relative performance derby. You can focus on absolute long-term value. You have the gift of patience. You don't have a boss breathing down your neck about last quarter's numbers. You're nimble enough to invest in small, interesting companies that are just too tiny for a multi-billion-dollar fund to even look at. And you can sift through the wreckage they leave behind, finding amazing bargains created by their panicked selling or their mindless buying.
And that's really the final thought I want to leave you with. Imagine the market is this big open field. All the institutional elephants are stampeding around in a tight herd, just chasing each other in circles, only paying attention to what the other elephants are doing. And in that chaotic race, they are trampling over and ignoring countless valuable opportunities. So the question is, are you willing to step away from the herd and look for the valuable crumbs they're leaving behind?
You know, some stories in finance are way more than just numbers on a page. They're cautionary tales. And the 1980s junk bond boom, oh, it's a perfect example. It's a wild story of greed, some seriously flawed ideas, and a really charismatic salesman who built a market that seemed to defy gravity, right up until it came crashing back down to earth. Let's dig in.
So picture this. It's the 1980s, and a market worth a staggering $200 billion just appears. It felt like it came out of nowhere. I mean, this wasn't some slow, gradual build. It was an explosion. And this brand new financial product, totally untested in a real economic downturn, was suddenly being sold everywhere as this safe, high-yield investment.
So that's the big question we're unpacking today, isn't it? How did this even happen? Who is the mastermind behind it all? What were the ideas? Some compelling, some, well, deceptive, that made it all possible. And maybe most importantly, why did it end with tens of billions of dollars just going up in smoke? The answers tell us a lot about how markets work and the power of a good delusion. All right, so here's our roadmap. We're going to start with that $200 billion delusion itself. Then we'll meet the man at the very center of it all, the so-called junk bond king. After that, we'll pull apart the myths that fueled this whole frenzy, look at the reckless financial tricks that made it seem legit, and see exactly why the whole house of cards collapsed. And finally, we'll talk about the lessons that, frankly, are just as important today as they were back then.
Okay, so let's set the scene. It's the 1980s. There's this huge sense of optimism in the air. After the rough economic times of the 70s, people were just hungry for high returns. And junk bonds, they seemed like the perfect answer. They offered these really high yields, but they were sold with this story of being a safe, secure investment. It was a brand new product, and yet it was pitched like a financial miracle.
And here's the crazy part. The danger wasn't some big secret. You had heavy hitters like Warren Buffett publicly ringing the alarm bells. But the market, it didn't just ignore them, it exploded. The people making money had such a powerful self-interest that it created this bubble of denial that just kept inflating, for a while anyway.
At the heart of this entire story is one man, Michael Milken. He basically invented this market. He was the architect, he was the evangelist, he was the guy running this massive financial machine.
So Milken's journey actually starts with a really solid academic idea. He's studying research that showed if you bought a diverse basket of bonds from struggling but once great companies, you could actually do better than buying high-quality bonds. And he puts this to work, trading these so-called fallen angels. But then he makes this pivotal and honestly disastrous leap. He decides to start creating and selling brand new junk bonds from scratch. And that's where the real trouble begins.
Okay, this right here is probably the most important thing to get. This is the fatal flaw. See those fallen angels, bonds from good companies that hit a rough patch? They were a good deal because you bought them at a huge discount. If the company turned around, you made a ton of money. That discount was your cushion, your margin of safety. But Milken's newly issued junk bonds, they were sold at full price. That means your upside was pretty limited, but your downside, the risk of losing everything, was massive. There was no safety net built in. And this was a crucial difference that, never really got mentioned in the sales pitch. So how do you sell a product with a fundamental flaw to the entire financial world? Well, you build a powerful, convincing story around it. And the central myth, the idea that the whole thing was built on, was that these bonds were actually safe. Let's look at how they pulled that off.
The main sales pitch was all about the low default rate, but it was basically a magic trick, a statistical illusion. For most of the 80s, the market was just growing so fast that the total number of bonds out there was expanding way faster than the number of companies actually going bust. Plus, they used clever tricks like raising extra cash just to make the first few interest payments, or using bonds that didn't require any cash payments for years. The bottom line is this, that low default rate wasn't a sign of health. It was just a sign of a market that hadn't blown up yet.
This quote from our source it hits the nail on the head. It really captures the marketing genius here. They weren't just selling a financial product, they were selling a solution for everything. Need money for a small company? Junk bonds. Want to take over a big, lazy corporation? Junk bonds. It was this universal cure-all, and the story got even bigger.
The whole narrative eventually turned into this kind of patriotic mission. Investors were told they were financing the little guy, the innovative companies that were going to create jobs and make America competitive again. It wasn't just about making a return anymore. It was about being part of the country's economic salvation. And that right there transforms a risky deal into a moral crusade, which is a lot harder for people to question. Okay, so you've got this great story. But to make the deals actually work, especially at the crazy high prices people were paying, you need some creative accounting, some new financial tools. Let's see how they built on the myth.
Two of the biggest tools were zero-coupon and pay-in-kind bonds, or PIK bonds. You can think of these as buy now, pay way, way later loans. The borrower didn't have to make any cash interest payments for years. Instead, the interest just kept piling up, adding to this giant mountain of debt. This totally severed the tether to financial reality. A buyer could pay a ridiculous price for a business because, hey, they didn't have to worry about paying the bills with actual cash for a long, long time.
Another really popular feature was something called an interest rate reset. This was basically a promise that, in the future, the issuer would adjust the interest rate to whatever it needed to be to make the bond worth its full face value again. It was sold as this ironclad guarantee against losing money, but as our source calls it, it was a financial placebo. And here's why.
So here's the paradox, right? The reset only works if the company's healthy, but a healthy company doesn't need it. If a company gets into real trouble, there's no interest rate high enough to make investors feel safe again. Promising to pay an even higher rate just makes the company's problems worse, piling on more debt and pushing it closer to bankruptcy. The promise was worthless right when you needed it the most. To make all these enormous prices seem reasonable, Wall Street pretty much had to invent a new way to measure value. They threw out traditional earnings and replaced it with this new metric, EBITDA. It was sold as this great proxy for a company's ability to generate cash, but it had a fatal flaw. Let's take a closer look.
So just look at this slide. It lays the problem out perfectly. You've got two companies. Company X is a service business, no big machines to replace. Company Y is a manufacturer with $20 million in depreciation costs. Both of them have the same revenue, the same cash expenses. So what does that actually mean?
Well, by the magic of this new math, both companies have an EBITDA of $20 million. But are they equally valuable? Not even close. Absolutely not. Company Y, the manufacturer, has to spend that $20 million just to replace its worn-out equipment and stay in business. It has no free cash left over. Company X, though, it gets to keep that $20 million. EBITDA completely hid this massive difference, and it made really bad businesses look just as good as great ones. All right, so you've got flawed products built on these misleading myths and justified by totally faulty metrics. But a market needs buyers. So who is actually buying this stuff? What was their motivation? If you understand the buyers, you understand why it was all destined to collapse. The first group was just regular folks, individual investors, who our source calls yield pigs. Through this new wave of high-yield mutual funds, they were just chasing the highest possible return they could find. And this created this insane competition among fund managers who had every incentive to buy worse and worse quality junk just to juice their reported yield and bring in more money. It was a total race to the bottom.
And then you had the gamblers. These were the savings and loans institutions, or thrifts. Deregulation had let them make riskier investments, and boy, did some of them go all in on junk bonds. And because their deposits were federally insured, they were basically gambling with taxpayer money. Think about it. If the bonds paid off, the owners got rich. If they blew up, the government covered the losses. It was a classic heads I win, tails you lose situation.
And finally, you had the desperate buyers, the insurance companies. See, back in the early 80s, they had sold all these investment contracts that guaranteed really high rates of return. But then, general interest rates fell and they were in a huge bind. To make good on their promises, they felt forced to reach for yield by loading up on junk bonds, which put their own companies and their policyholders at incredible risk.
By 1990, the party was officially over. As soon as new bonds stopped being issued, the flawed math of the default rates finally caught up with reality. Defaults went through the roof. And as this quote just so vividly puts it, the liquidity that was promised just vanished. The market froze solid. All those panicked investors who tried to sell found out there was nobody buying. They were trapped. So, what can we all learn from this mess?
So, why does a story from the 1980s still matter so much today? Well, it's because the patterns of human behavior, the greed, the fear, the self-delusion, they never, ever change. The junk bond debacle gives us these timeless lessons for any investor, and you can see echoes of it in markets all the time.
So what are the big takeaways? Well, first, being a successful investor isn't just about making big gains. It's about avoiding the catastrophic losses. Second, you have to be skeptical of new metrics. They're almost always invented to justify paying too much for something. Third, remember that you can't turn a bad asset into a good one with fancy financial engineering. A pile of junk is still a pile of junk.
And finally, even if you stay out of a bubble yourself, its effects can spill over and inflate prices everywhere.
Look, new investment fads are going to happen. It's inevitable. They'll have a fantastic story, they'll promise easy money, and they'll grow way beyond any rational limit. And there's never going to be a bell that rings at the top. The real lesson from the junk bond story isn't just about history, it's a field guide for what's coming next. So the question to ask yourself is, when the next great delusion comes along, will you be able to see it for what it really is?
Hey everyone, and welcome. Today, we're going to dig into something that might sound a little strange at first. We're going to explore this really powerful idea that the best way to build wealth isn't actually about chasing huge, spectacular gains. Nope, it's about an almost obsessive focus on one simple thing: not losing your money. So where do we even begin with a concept like that? Well, let's start with a couple of rules from one of the greatest investors who ever lived. And, they're so simple, you might actually be tempted to just brush them off. But trust me, that would be a huge mistake. You've probably heard this one before, right? It's the classic Warren Buffett quote: rule number 1, don't lose money. Rule number 2, never forget rule number 1. It sounds so simple, it's almost a joke. But what is he actually getting at here? It's not about avoiding every single bit of risk. It's much deeper than that. So let's be clear. This isn't about hiding your cash under the mattress. The real principle here is protecting your principal, that's your starting capital, from a major, significant, and potentially permanent hit. It's about playing the long game with a really strong defense. But even with this super simple rule from Buffett, just look around. That urge to speculate, to gamble, it's everywhere. We see stories of people getting rich overnight on some new hot stock or crypto, and that temptation, that feeling of, hey, I'm missing out, can be almost impossible to fight. So how does this whole don't lose money philosophy actually stack up against what we normally hear, the conventional wisdom? Let's put them right next to each other, because the difference is, well, it's pretty stark. Okay, so on the one hand, you have the loss avoidance strategy we're talking about. Its main goal is just to not take a big hit. But on the other hand, you have the conventional market wisdom that says the real risk is not being in the market at all, that you need to be fully invested all the time. These are two completely different universes of thinking. And this, of course, brings us to the big question, the one that everybody asks, right? But wait a minute, don't you have to take big risks to get big returns? It's the classic argument for why you should chase those crazy high-flying bets. So let's put that idea to the test. Let me ask you this, and be honest. Would you bet everything you have, your house, your car, your savings, everything, on a single flip of a coin? Heads, you double it all. Tails, you lose it all. Of course you wouldn't. No sane person would. Why? Because the absolute agony of losing everything would be so much worse than the temporary joy of doubling it. And that little coin toss thought experiment, it proves something fundamental about us. For the vast majority of people, a huge financial loss can permanently, catastrophically ruin your standard of living. A huge gain, yeah, it's great, but it probably won't improve your life in the same dramatic opposite way. And that's exactly why avoiding loss has to be the foundation, the very cornerstone of how you invest. Now, this isn't just about feelings and psychology. The math behind avoiding big losses is one of the most powerful and frankly most overlooked forces in all of finance. So let's break down the numbers. Okay, check this out. This chart shows the absolute magic of compounding. Just look at that line for 16% returns. If you start with just $1,000 after 30 years, it becomes more than $85,000. It's unbelievable. Time and consistency are your secret weapons. But, and this is a really big but, there is a very dangerous flip side to this magic. A single nasty loss can completely break that beautiful compounding machine. It can literally wipe out years, sometimes even decades, of your patient hard work, just like that. Let's make this really concrete. Let's compare two investors. You've got investor A, who is just steady Eddie, right? Makes a solid 16% every single year. Then you have investor B, who's a total rock star, pulls in an amazing 20% a year for 9 years straight, but then in year 10, they hit a snag and lose 15%. So what do you think? Who comes out on top after a decade? Is it the consistent, kind of boring performer, or the high flyer who just had one little slip up at the very end? And here's the answer that shocks a lot of people. It's investor A. The steady, consistent one actually ends up with more money. Think about that. Avoiding that one big loss was mathematically more important than all of those amazing superstar years of gains. So if the math is so clear, why doesn't everyone invest like investor A? Well, it comes down to something called psychic income. See, for 9 out of those 10 years, investor B felt like an absolute genius. They felt smart, they could brag to their friends, and that emotional payoff, that feeling of winning, is a really powerful and dangerous drug. Here's a fantastic way to think about it. A smart investment strategy is basically a form of insurance. You might give up a tiny bit of gain in the good years, that's your insurance premium, but you do it to protect yourself from that rare but absolutely devastating financial flood. Okay, this entire way of thinking leads us straight into one of the most common and most destructive mistakes that investors make. And the crazy thing is, they often don't even realize they're doing it. It's a trap they set for themselves right at the beginning. I mean, it sounds so responsible, doesn't it? To set a goal to say, I want to earn 15% a year. But that one seemingly smart decision can actually back you into a corner and force you to make some really, really bad choices. And this illustration just nails the problem. In almost any other job, if you want a better result, you just work harder. A ditch digger can work an extra hour and get more pay. But as an investor, you can't just think harder or work overtime to force the market to give you 15%. The market just doesn't care about your goals. The second you lock in on a specific number, your brain changes. You stop looking at the whole picture and you start focusing only on the upside potential. You begin to ignore, or even worse, justify, the enormous risks you might have to take just to have a shot at hitting that arbitrary number you picked. The goal itself becomes the danger. Okay, so if targeting a specific return is a trap, what's the alternative? What's the right way to do it? Well, we need to completely flip the script. We need to build a totally new, much more resilient framework from the ground up. Here's the new approach, and it's a total game changer. First, you stop targeting returns. Instead, you target risk. You start by establishing your baseline. What's the return you can get for taking virtually zero risk, like from a US Treasury bill? From there, you only agree to take on more risk if and only if an investment promises to compensate you with a considerably higher potential return. You have to get paid for the danger you're taking on. You know, most investment strategies you hear about are all about offense, all about chasing returns. But there is one time-tested philosophy that is built entirely from its very foundations on this principle of avoiding catastrophic loss. It puts risk first, not returns. It forces you to be disciplined, and when you follow it correctly, it leaves you with the single most important asset any investor can possibly have, a margin of safety.
All right, let's talk about one of the most powerful, time-tested investment philosophies out there, value investing. We're going to dig deep into what really makes it tick, and we're going to do it by answering one single crucial question. How do the best investors on the planet consistently protect themselves from absolute disaster while still managing to pull off incredible returns?
So here's our roadmap. We'll kick things off with the big problem every investor has to deal with. Then we'll uncover the beautifully simple idea at the heart of value investing. From there, we'll dive into its most important rule, the margin of safety, and the kind of mindset you need to have. Then, we'll see why this whole approach really shines when things go sideways, and finally, we'll talk about the real and often surprising price you have to pay to do this successfully. Let's get into it.
Okay, so let's start with the biggest challenge in investing, period. How do you avoid that one catastrophic loss that can just wipe you out?
Now, this isn't just some academic question, right? This is the real-world problem that keeps investors up at night. Because all it takes is one massive mistake to erase years and years of hard work. So what's the secret? How do you build something that lasts?
Well, the secret is all about avoiding something called a torpedo stock. You've probably seen one of these before. It's a company where the stock price is just pumped full of hype and sky-high expectations. A perfect example is Comp Computer, way back in 1991. Everyone was betting on massive growth. But then, when the company just announced a small dip in earnings, boom, the stock got torpedoed. It fell by half in a little over 2 months. These are the investments that sink portfolios.
So, if avoiding those torpedo stocks is your defense, what's your offense? Well, it turns out there's a philosophy built from the ground up to do exactly that. And you know what? It's incredibly simple. Here's the textbook definition of value investing. But I want you to focus on just 2 words here: significant discount. That right there is the whole game. See, value investing isn't just about finding good companies. It's about having the iron discipline to buy those great companies only when the market is practically giving them away. That bargain, it's everything.
You know, you can forget all of the complicated spreadsheets and financial models for a second. At its absolute core, value investing is this. You figure out what a business is actually worth, let's call that $1, and then you patiently wait until you can buy it for 50 cents. That's it. Everything else flows from that one powerful idea. And that 50-cent part, that discount, that's your protection. That's your buffer against a crazy, unpredictable world. It is, as the father of value investing Benjamin Graham said, the most important concept of all. So here's the key thing to understand. The margin of safety isn't just about getting a good deal. It's a deliberate cushion. It's you admitting, hey, the future is uncertain. I might be wrong about my analysis. The economy could go nuts. Bad luck is a real thing. Your margin of safety is your financial shock absorber for all that stuff. Warren Buffett, of course, gave us the perfect analogy for this. Think about building a bridge. You don't design it to hold the exact weight of the trucks going over it. No way. You over-engineer it like crazy just in case. That huge gap between what the bridge can handle and the load you actually put on it, that is the margin of safety. And it's the exact same idea for your portfolio.
So how do you find this in the real world? Well, traditionally, value investors have focused on tangible assets, things you can touch, like factories, land, inventory. And the reason is pretty simple. You can value that stuff with a lot more certainty. If the business goes belly up, you have a pretty good idea what the physical assets are worth. Intangible assets, like brand reputation, are super powerful, but they are way harder to nail down. And if public opinion suddenly shifts, that value can just, poof, evaporate, leaving you with nothing. That's why a solid base of tangible assets provides a much stronger margin of safety.
Now, understanding the logic here is one thing, but actually putting it into practice, day after day, when the market is yelling at you and there's temptation everywhere, well, that takes more than just being smart. It requires a certain temperament, a certain kind of discipline.
And here's another brilliant analogy from Buffett. He says investing is like a baseball game where there are no called strikes. Just think about that. You can stand there at the plate and hundreds of pitches, investment opportunities, can just fly by. You don't have to swing at any of them. You're just waiting for that one perfect pitch, right in your sweet spot, the one you can knock out of the park. And this is a massive advantage over most professional institutional investors. Think about it. They're usually forced to be fully invested, all the time, which means they have to swing at pretty much every pitch that comes their way, whether it's good, bad, or ugly. The value investor, on the other hand, has the freedom to just do nothing, to just wait. And that patience, well, that's a superpower.
But this brings us to a really tough question. It's the dagger at the heart of this whole philosophy. I mean, it's great to buy $1 for 50 cents, but what if that dollar is melting? What if it's on its way to becoming 80 cents or 60 cents? How do you protect yourself from that?
Value investors have a three-part defense against this. First, they are always conservative when they value a business. They focus on the worst-case scenario, not the best. Second, if they think a business might be declining, they demand an even bigger discount. So now, maybe they'll only buy that dollar for 40 cents. And third, they look for a catalyst, some specific event like a merger or a spinoff that's going to unlock that value pretty quickly before it gets a chance to fade away.
So what we have here is a super patient, disciplined approach that is just obsessed with safety. And as you can probably guess, this philosophy really shows its muscle when things get tough for everybody else.
You've probably heard this famous saying, and it captures the idea perfectly. When the market is booming, everybody looks like a genius. Every strategy seems to work. But a market crash? That's the real test. That's when the tide goes out, and you finally get to see who was taking foolish risks and who built their portfolio on solid ground.
And this all works because value investors see the market in a totally different way. A lot of modern finance is based on this idea called the efficient market hypothesis, that the market is like a perfect, rational weighing machine that prices everything correctly. Value investors say, no way. They see the market as a voting machine, a wild, emotional, short-term popularity contest driven by fear and greed. And it's in that gap between the voting and the weighing, between perception and reality, where they find all their opportunities.
Let me show you a classic real-world example of this. Back in 1987, the oil giant Texaco filed for bankruptcy. The voting machine completely panicked. Everybody dumped the company's bonds and the price just plummeted. But value investors, they acted like a weighing machine. They did the quiet math and realized the company's assets were still worth way more than its debts. By buying up those bonds when everyone else was terrified, they set themselves up for potential returns of over 40%. Not by speculating, but just by being rational when the market was not.
And check out this other example from Telefonos de Mexico. The stock was basically priced for death at 10 cents a share. Nobody wanted it. A few years later, the business itself hadn't changed all that much, but investor psychology had. The stock became a hot favorite and soared to over $3. That's the incredible power of buying when expectations are on the floor.
Okay, the logic is solid. The history is compelling. It all seems pretty simple, right? So why isn't everybody a value investor? Well, that brings us to our final and maybe most important point.
The reason it's so hard is because it's really easy to use the name value investor without actually having the discipline. The source material calls these folks value pretenders. They talk a big game about buying bargains, but their math is always way too optimistic. They end up overpaying for things, which means they have no real margin of safety. They might look smart for a while in a rising market, but when that tide inevitably goes out, you find out their portfolio was built on sand and they suffer huge losses.
And that, right there, is the final takeaway. Value investing is simple to understand, but it is incredibly difficult to do. The hard part isn't the math. The hard part is having the discipline to say no, the judgment to spot a real opportunity, and more than anything, the patience to sit on your hands and do nothing until that perfect pitch finally arrives. So the real question isn't for me, it's for you. Do you have it?
Welcome to The Explainer. Today we're diving into investment philosophy that kind of flips conventional wisdom right on its head. See, it's not about trying to predict the future or chasing the hottest stocks. It's actually about something much, much simpler, not losing money. So let's break down the core principles of value investing. Okay, so let's just jump right in and ask a really fundamental question. If you strip away all the noise, the talking heads on TV, the complicated charts, what is a value investor actually at their core trying to do? What's the real endgame? I think we all have this image of a Wall Street genius who can just see the future, right? But the value approach, it has almost nothing to do with that. It's not about forecasting where the economy is headed or what the Fed is going to do with interest rates. That's a whole different ballgame.
So here it is, and it might sound almost too simple, but this is the key. The number one goal is avoiding loss. That's it. This single idea, it's the North Star. It's the concept that guides every single decision and shapes this entire way of thinking from the ground up.
This whole philosophy of not losing money, it really stands on three big ideas, three central pillars. You can think of them like the three legs of a stool. You take one away and the whole thing gets wobbly. They all have to work together to build this cohesive, risk-averse strategy. So here they are, the three pillars. First, you've got a bottom-up strategy. This means you're more like a detective, examining one business at a time instead of being a fortune teller trying to predict the whole economy. Second, an absolute performance focus. This is about hitting your own goals, not about beating some random market index. And third, a really deeply ingrained risk-averse approach that, as we'll see, completely redefines what risk even means. All right, let's dig into that first pillar, the whole bottom-up idea. To really get it, though, I think it helps to see it right next to its total opposite, the top-down approach that, honestly, most of the investment world follows.
I mean, just look at the difference here. The top-down approach, it's like building a house of cards. You have to be right about the economy, then right about the industry, then right about the company. If any one of those predictions is wrong, the whole thing can come crashing down. The bottom-up investor just ignores that entire fragile structure. They're just looking for individual bargains, one at a time. They're looking for solid businesses that are on sale for less than they're actually worth. And this quote just nails it, doesn't it? The hard part isn't gazing into a crystal ball. The hard work is in the analysis and figuring out what a business is truly worth. And once you've done that homework, the strategy becomes incredibly simple. Buy it for a discount, and then you wait. That patience is just as crucial as the purchase itself.
Okay, on to the second pillar, and this one is a real mindset shift. It completely redefines how you even keep score, how you measure success. It's about moving away from this idea of competition and focusing on your own finish line.
You know, this distinction is so important. Most of the financial industry is stuck in a relative performance trap. It's this constant race to beat the S&P 500. And that forces you to stay fully invested all the time, even when things are ridiculously expensive, just so you don't fall behind. The absolute performance mindset asks a totally different question. It's not, am I beating the market? It's, am I safely reaching my financial goals? And that frees you up to hold cash when nothing looks cheap, to prioritize protecting your money over chasing a rally. This quote just cuts right through all the jargon. It's so true. I mean, you can't pay your mortgage with relative performance. Beating the market by a few points when it's down 30% might look good on a chart, but you still lost a ton of money. At the end of the day, only absolute returns, the actual cash in your account, matter.
And now for that third and final pillar. This one forces us to confront maybe the most misunderstood, most misused word in all of finance: risk. For a value investor, risk isn't just about how much a stock price bounces around. It's way more fundamental than that.
See, value investors are super specific here. Risk isn't just one thing. It's a two-part equation. You have to ask yourself two questions. First, what's the actual chance that I could permanently lose my money here? And second, if I lose, how much could I possibly lose? You need to think about both. You could have an investment with a low chance of failing, but if it does fail, you lose everything. Well, that's still incredibly risky.
So, we've all heard this one, right? It's practically drilled into you in Finance 101. To get higher returns, you must take on more risk. It's presented as this iron law of the universe.
But from the value perspective, that's totally backward. Risk is the enemy of return. Think about it. High risk doesn't guarantee a high return. It just guarantees a higher chance of losing your money for good. The only reason high-risk things sometimes have high returns is because widespread fear has made them incredibly cheap. The amazing return you get isn't a reward for the risk. It's a reward for buying something on sale when everyone else was panicking.
All this talk about risk leads us straight to a metric that the academic world absolutely loves, but value investors, well, they pretty much despise it. It's a single Greek letter that's supposed to capture all investment risk: beta.
So what on earth is beta? Well, it's basically an attempt to boil down all the complicated, messy, real-world risk of a business into one clean, simple number. All it does is look at how much a stock's price has wiggled around in the past compared to the market. If it wiggled a lot, it gets a high beta, and that gets labeled high risk.
And yeah, this quote just perfectly captures the reaction. The whole idea is, frankly, preposterous. Why? Because it makes a huge, dangerous mistake. It confuses price volatility with actual risk. It assumes that the squiggles on a chart from last year can tell you everything you need to know about the future safety of a business.
I mean, just look at everything beta completely ignores. It knows nothing about the actual business, the debt, the management, the competition. It's clueless about major economic shifts. And, this is the crazy part, it's totally blind to the price you pay. It would say IBM is just as risky at $50 as it is at $100. It also misses that a true bargain has way more room to go up than down. It's a metric with a massive, massive blind spot.
Okay, so if risk is this big, ever-present thing that's hard to measure, and the most popular tool for it is basically useless, what do? How does a smart investor actually protect themselves from a future that's always uncertain?
The very first step is a huge mental shift, a complete 180 in your thinking. For a value investor, those daily price swings are not risk. They're just noise. In fact, they're not just noise, they're opportunities. It's that classic idea of Mr. Market, your manic-depressive business partner. When he's terrified, he shows up at your door offering to sell you his shares for pennies on the dollar. That volatility, it's your friend.
Now, to manage the real risk, the risk of permanently losing your capital, the value investor has a toolkit. Of course, there's diversification, so one bad apple doesn't spoil the bunch. There's hedging, when it makes sense, for some extra protection. But the big one, the most powerful tool of all, the very bedrock of this whole thing, is investing with a margin of safety.
This is it. This is what it all comes down to. That margin of safety is your cushion. It's your shock absorber for a world that's always going to throw you curveballs. It's the room for error that protects you when you're a little off in your analysis or when bad luck just happens. The safety doesn't come from a fancy formula. The safety comes from the bargain you insisted on in the first place.
And that leaves us with one last thing to think about. In a financial world that is obsessed with finding the next big thing, with chasing trends and trying to look smart in the short term, maybe the biggest, most powerful advantage you can have is to just refuse to play that game. Maybe the ultimate edge is to build your entire strategy around one simple disciplined goal: not losing. All right, let's get right into it. If you're an investor, you know there's this one question that's always hanging over your head. What is a business actually worth? I mean, it sounds so simple, right? But honestly, it's one of the hardest and most critical puzzles you'll ever try to solve in finance. And that's really the core question we're going to dig into. We're not talking about the stock price that's jumping all over the place every single day. Now, we're talking about the real, underlying value of the company. So, how do you even begin to find that number? How do you cut through all the noise to find the actual signal?
You know, it's funny. As humans, we crave precision, don't we? We want to know that a company is worth exactly $127.42. It feels safe. It feels certain. But here's the thing. The reality is, well, it's a lot messier. The best you can ever really do is find a range of value, like it's probably worth somewhere between $100 and $150, and chasing that single perfect number, that's probably one of the biggest traps an investor can fall into. And look, this isn't some hot new take. We're talking about wisdom from the legendary Benjamin Graham from way back. He basically said, hey, forget about pinpoint accuracy. The real goal isn't to know the exact value. It's just to know if the value is good enough. Is it adequate? Is there enough of a safety cushion there? That's how the pros think, in ranges and approximations.
So, here's our game plan. We're going to break down how to think about this stuff like a real pro. First, we'll talk about why that whole idea of precision is just an illusion. Then we'll get practical and build out a valuation toolbox. After that, we'll put it to the test with a fascinating real-world case study. We'll also cover some common traps you definitely want to avoid, and we'll wrap up with the mindset, the secret sauce really, that sets the best value investors apart.
All right, section 1. Let's tackle this foundational idea head-on, the illusion of precision. Because chasing that one perfect number, it's not just hard, it's actually dangerous. It's a flawed way of thinking that can get you into some serious trouble.
So why is it a myth? Well, think about it. First off, those financial reports you're looking at, they're not gospel. They're basically an accountant's best effort to fit reality into a set of rules. They're not designed to show true economic value. And second, a business isn't a statue. Its value is always in motion, right? It's fluctuating with the economy, with its competitors, with everything. And what about those fancy spreadsheets with net present value calculations? They look so precise, but they're built on a foundation of guesses about the future. And you know the old saying, garbage in, garbage out.
Okay, so if we can't get a perfect number, are we just lost? Not at all. What we do is we build a toolbox. We're going to look at 3 main tools that investors use. Each one gives you a different angle, a different perspective, and together they help you map out a conservative range of what a business might be worth.
Tool number 1, net present value, or NPV. This is the classic one. You're basically looking at the company as a living, breathing thing, a going concern. The idea is to estimate all the cash it's going to spit out for the rest of its existence, and then figure out what all that future cash is worth in today's money. The big catch? Well, you have to predict the future, and we all know how easy that is.
All right, tool number 2 is liquidation value. I like to think of this as the what if everything goes wrong valuation. You ask yourself a simple question. If this company just closed up shop tomorrow, sold everything it owns, the buildings, the inventory, all of it, and paid off all its debts, what cash would be left? It gives you a really conservative rock-bottom floor for the company's value.
And our third tool is stock market value. You can also call it relative valuation. This is kind of like comparison shopping. You look at similar businesses out there and see what the stock market thinks they're worth. Now, it's not a perfect science because, let's be real, the market can be pretty irrational sometimes. But it's a super useful yardstick. It tells you, okay, this is how Mr. Market is pricing this type of company today.
Now, there's a little variation on this, a sort of real-world sanity check called private market value. This isn't some complex new formula. It's just asking, what would a smart business person, an expert in the industry, pay to buy this entire company? You often look at recent takeover deals to get a feel for this. But a word of warning, you got to be careful here. In a hot market, takeover prices can get totally out of whack, so you have to use this one with a healthy dose of skepticism.
Okay, that's enough theory. Theory's great, but let's see these tools in action. Let's get our hands dirty with a real case study. We're going to rewind the clock to 1990 and look at a company called Esco Electronics, right after it was spun out from its parent company.
Okay, just look at these numbers. This is where it gets wild. The market was selling this stock for $3 a share. $3! But get this, the company's tangible assets were worth over $25 a share. And even if you get super conservative and just look at its net working capital, which is basically the cash you'd have after paying off every single debt, that was still $15 a share. The stock was trading for pennies on the dollar of its actual assets. It's just an incredible disconnect.
So that's the assets. What about the business itself? Let's pull out our NPV tool and run a total doomsday scenario. Let's pretend things never get better. The business just kind of limps along forever in its depressed state. Even with that incredibly pessimistic view, the NPV came out to $4.70. Think about that. Even if the absolute worst happened, it was still worth way more than the $3 the market was asking for.
Okay, so that's the floor. Now, what if we dial back the pessimism just a little bit? What if we assume a reasonable scenario where ESCO makes just some modest, totally achievable improvements? All of a sudden, the NPV jumps to almost $15 a share. And this is a perfect illustration of what we were talking about. The value isn't one number, it's a range. It was somewhere between a disaster value of about $4.70 and a reasonable value of nearly $15, and both of those numbers just crushed the $3 price tag.
And it wasn't just one tool pointing this way. All the tools in our toolbox were screaming the same thing. The liquidation analysis, it suggested that just winding the company down slowly would net you more than $15 a share. We're talking 5 times what you could buy it for on the stock market. Every angle you looked at it from, it was just absurdly cheap.
And this is the punchline, right here. You didn't need to be a genius. You didn't need to know if ESCO was really worth $10 or $15 or $20. Who cares? All that mattered was that it was worth a ton more than $3. The price was so low, it was already pricing in a complete catastrophe. Anything better than that, and you were going to make money. That is what a margin of safety looks like.
So the ESCO story really shows you the power of using this toolbox approach. But knowing what to do is only half the battle. You also have to know what not to do, so let's talk about a few of the common metrics that look shiny on the surface but can really lead you astray. First on the list is the obsession with earnings per share, EPS. It's everywhere, but it can be a total mirage. The big problem is that earnings are not cash. Earnings are an accountant's opinion. They can be manipulated, they can be full of weird accounting rules that don't match reality, and a company can have a great EPS number one year just because of some one-time sale that will never happen again.
Next up, let's talk about the book value fallacy. Book value is literally just the historical price a company paid for its stuff. That's it. It tells you nothing about current value. Think about it. A piece of land bought in Manhattan in 1950 is on the books for pennies, but it's worth a fortune today. On the flip side, a factory full of 1980s technology might be on the books for millions, but it's actually worthless. So book value can be incredibly misleading.
And finally, please be careful of the dividend yield trap. When you see a super high dividend yield, your first thought shouldn't be great deal, it should be what's wrong. A high yield usually means the stock price is in a free fall. Struggling companies will keep paying that dividend to look healthy, but they're often just handing you your own money back. They're liquidating the company one dividend check at a time. It's a return of your capital, not a return on your capital. Big difference.
Okay, so let's pull it all together. We've busted the myth of precision, we've built our toolbox with NPV, liquidation, and market value. We've learned about the traps to avoid. All of this really boils down to one thing, a specific mindset. This is the real edge. This is what separates the consistently successful investors from the crowd.
And this quote here, it just nails it. Your advantage as an investor isn't going to come from having a fancier spreadsheet or pretending you can predict the future. The real edge comes from discipline. It's about having the patience to just sit and wait for a no-brainer deal like ESCO to come along. It's about staying within your circle of competence, only investing in things you truly understand well enough to value, even if it's just a rough conservative range.
So I'll leave you with this one final thought. A question to ask yourself about your own investing. Are you spending your time and energy chasing that dangerous illusion of precision? Or are you focused on finding what actually matters? A massive discount to a conservative estimate of value? A true margin of safety?
All right, welcome back. You know, the investing world is just a constant fire hose of information, right? Thousands of stocks, bonds, funds, it's overwhelming. The real trick isn't just finding something to invest in, it's finding one of the great ones. So in this massive sea of noise, how do you actually find those hidden gems? Well, that is exactly what we are going to break down today. So let's start with a fundamental truth of this whole game. Genuinely great investment ideas do not just fall out of the sky and into your lap. They are rare, they are incredibly valuable, and you have to hunt them down. This isn't about luck. It's about having a map and knowing exactly where to start digging. And this is the million-dollar question, isn't it? I mean, if you just start scanning headlines or picking stocks at random, you are going to get absolutely nowhere fast. So think of what we're doing here as creating your own personal treasure map, a guide to finding the market's hidden bargains. Here's our game plan. First, we'll talk about the haystack problem, why most stocks just aren't worth your time. Then, we'll roll out that treasure map I mentioned, showing you the specific places to hunt. We'll dig into why these bargains even exist, what kind of mindset you need to actually buy them, how to research smarter, not harder, and finally, why this is all a long-term game. Okay, first up, the haystack problem. Here's a tough pill to swallow. Most investors spend the vast majority of their time looking at companies that are, well, they're priced about right. It's that classic needle in a haystack scenario. But it's even worse, because most of the hay looks exactly like a needle, tricking you into wasting your precious time and energy. Let's just put a number on this to really let it sink in. You could easily, and I mean easily, spend 99% of your time analyzing companies that are perfectly fairly valued by the market. There's just no edge there for you. It shows you just how pointless a random, unfocused search really is. The secret is to avoid that haystack altogether. So, if we're not supposed to be digging through the haystack, where on earth do we look? Well, that brings us to the solution, the treasure map. You see, a smart investor doesn't search everywhere. They focus their energy on very specific hunting grounds where the bargains are much, much more likely to pop up. Our treasure map points to 3 distinct territories. First, we're on the hunt for companies that are trading at a crazy discount to what they'd be worth if they were just broken up and sold for parts. It's like buying $1's worth of assets for 50 cents. Second, we're looking for rate of return situations, think mergers, where we can calculate a pretty specific potential profit over a set amount of time. And third, we're going to explore asset conversions, which are these big corporate shakeups like bankruptcies, where a ton of value can get unlocked in all the chaos. Okay, let's dive into that first niche, discounts. This is classic, old-school, deep value stuff, finding companies the market hates so much that it values them for less than their individual parts are worth. Now, you can use a computer screen to get a starting list of ideas, but here's the part almost everyone gets wrong. You absolutely must verify that data yourself. The databases are full of errors, and the real edge comes from rolling up your sleeves and doing that manual deep dive. Niche number 2 is all about finding these rate of return opportunities. These are usually tied to big corporate events. So, for example, Company A says they're going to buy Company B for $10 a share. But if Company B's stock is only trading at, say, $9.50, you can buy it and potentially lock in that 50-cent profit when the deal closes. That's basically risk arbitrage. You have a known exit price and a rough timeline, which lets you calculate your potential return right up front. And our final hunting ground is asset conversions. This usually happens during a massive corporate shakeup. Just think about a company going through bankruptcy. To most people, it looks like a total disaster, right? But as part of that whole process, the old, maybe worthless stock might get exchanged for brand new stock in a healthier, reorganized company. For the investors who do their homework, these really messy situations can unlock a ton of hidden value. Okay, so we've got our map, we know where to look, but finding what looks like a bargain is only the first part of the puzzle. The next, and honestly the more important question to ask is, why? Why is the stock so cheap in the first place? And this quote just perfectly captures the mindset you need to have. You see, a cheap price tag is not an automatic buy signal. It's a signal to get skeptical and start digging. Is there a giant hidden flaw? Is the house built on a sinkhole? Or is there some other less scary reason for the discount? Your job is to find out which it is. So this really shows you the 2 sides of that skepticism. The fear is that the company is cheap for a very good reason, that its business is fundamentally broken. But the opportunity is when it's cheap for reasons that are temporary or structural, things that have nothing to do with the actual quality of the business. That inefficiency, that's where a value investor makes their money. So what are some of these reasons? Well, here are some of the biggest ones. You have institutional constraints, where a giant mutual fund is literally forced to sell a great stock just because its market cap got too small. You have market inefficiencies, especially in tiny, obscure companies that no Wall Street analyst bothers to cover. And you even have stuff as simple as year-end tax selling, where people are just dumping shares to get a tax write-off, pushing the price down for no good fundamental reason at all. This all leads us to mindset. Because look, it's not enough to just find these opportunities. You have to have the guts, the psychological strength to actually act on them. And by its very nature, value investing is contrarian. It means you are betting against what everyone else is doing. I mean, just look at this comparison. The herd chases whatever's popular. It feels safe, and hey, it's often profitable for a little while. The contrarian does the exact opposite. They buy what everyone else is selling, ignoring or just doesn't know exists. And this means, and this is so important, you will almost certainly look wrong at first. Your stocks might go down before they go up. The key isn't just being different. It's being comfortable looking like a fool in the short term, because you know the herd's fear has created an incredible long-term opportunity just for you. Okay, so you've found a potential bargain, you've got that contrarian mindset ready. Now what? How much research is actually enough? Because the goal isn't to know everything. That's impossible. The goal is to know enough to act with confidence, especially when you have a big margin of safety. And this is where that good old 80-20 rule is so powerful. That first 20% of your research time is probably going to give you 80% of the most critical information you need. After that point, you really start to hit diminishing returns. Trying to learn every last detail about a company can be a trap that just leads to analysis paralysis, and you end up doing nothing. And you have to embrace this paradox. It's at the very heart of value investing. Uncertainty and low prices are two sides of the exact same coin. If you wait until the future is perfectly clear and all the good news is out, well, the bargain is long gone. The entire opportunity exists in that uncomfortable, uncertain moment, when you're protected only by your research and your margin of safety. So, what's one of the absolute best signals you can find during your research? Insider buying. And this quote just says it all. A CEO or an executive might sell their stock for a million personal reasons. They're buying a house, paying for college, diversifying their portfolio, but they only buy their own company's stock on the open market for one reason and one reason only. They believe it's undervalued and it's going up. It's an incredibly powerful clue that management sees something the market is missing. Finally, let's put this whole thing into the right frame of mind. Investment research isn't a task you just do once and then you're done. It's a continuous, ongoing, long-term game, where the work you put in today often pays off much, much later. I absolutely love this definition. At its core, research is just a filtering process. You're taking these huge mountains of information, the chaff, and you're trying to find those very few precious kernels of insight, the wheat, that actually move the needle. And believe me, there is a whole lot of chaff out there. And this might be the single most important takeaway from all of this. Doing the research makes you $0. Even buying the stock makes you $0. The profits only show up much, much later, when the rest of the world finally wakes up and agrees with your analysis. And that requires a profound, deep level of patience. The seeds you're planting today might not sprout for months, or in some cases, even years. So we'll end on this thought. The research you do today isn't always for an investment you're going to make tomorrow. A lot of the time, it's just building your knowledge base, preparing for opportunities that might not show up for a long time. It's a continuous process of learning and waiting for the perfect pitch. So the real question you have to ask yourself is this: are you prepared to play the long game? All right, welcome. Today we're going to go on a little bit of a treasure hunt. We're not looking for lost gold or anything like that, but for something that can be just as valuable. We're going to explore those overlooked, sometimes kind of messy corners of the market where the pros, the real value investors, find their absolute best ideas. So let's get into it. So this is the big question, isn't it? If the whole idea is so simple, just buy things for less than they're worth, why isn't everybody a millionaire? Well, the answer is that the real bargains, those true 50-cent dollars, they're almost never just sitting out in the open for everyone to see. The most amazing discounts are found when you're willing to do the work that other people just won't. And that means you've got to dig into situations that look really complicated or, frankly, kind of boring on the surface. It's all about ferreting out value that you can't just find on a normal financial statement. It's about seeing what everyone else misses, or maybe what they choose to ignore. Okay, so let's say you've done the work, you've found that hidden value. How do you actually make money from it? I mean, you can't just sit around forever hoping the world eventually agrees with you. You need a key, You need something that's going to unlock that value and basically force the market to recognize what you saw. And in investing, we call that a catalyst. Now, a catalyst is what changes the entire game. See, it takes the success of your investment out of the hands of, market mood swings, and it puts it on a much clearer path. A catalyst is a specific, predictable event that forces that gap between the cheap price and the true value to slam shut. The process itself, at least in theory, is really simple. Step 1. Your homework helps you find an asset that you can buy for way less than it's worth. Step 2. That specific event you were waiting for, the catalyst, actually happens. And then step 3, that event makes the hidden value real, turning your discount on paper into actual profit in your pocket. And these catalysts, they're not some kind of mystical force. They are concrete, real-world corporate actions. We're talking about stuff like a company getting bought out, or a big division getting spun off into its own separate company, or maybe an activist investor showing up and demanding changes. These are the signposts you're looking for on your treasure map. Okay, so let's pull out our first map. One of the best hunting grounds for value is in places that other investors are actively running away from. The unloved, the unwanted, the totally misunderstood parts of the market. Places where the negative perception is so strong it creates a massive opportunity. And this quote just says it all. I mean, think about it. A corporate liquidation, it sounds like total failure, right? The end of the line. People call it cigar butt investing. The idea of picking up some gross, soggy cigar butt off the street just to get one last free puff. It sounds disgusting, and that's the point. That really negative image is exactly why these things can be so profitable. So check this out. This is the City Investing Liquidating Trust from back in the 80s. When this big, messy company decided to liquidate, investors didn't get cash. They got units in a trust that held, this crazy collection of random assets like real estate and factories and insurance companies. Most people took one look at that mess and just said, nope, I'm out. And here's the crucial part. The selling wasn't logical. It was a stampede. People were already mad at the company. Big institutions literally had rules that said they couldn't own cheap, delisted stuff like this. You couldn't even get a price quote for it easily. All of this created this giant wave of selling that had nothing to do with what the assets were actually worth. So what was the payoff for the few people who were willing to jump into that mess? Well, those trust units were being dumped for about $3. But over the next few years, as all those assets were sold off, the trust paid out a total of around $9 per unit. That's a 3x return, just for patiently buying what everyone else was throwing in the garbage. And liquidations aren't the only unloved spot. The same idea works for securities that are just weird. Things like bonds with strange features or preferred stocks with unique rules. They're so complicated that most analysts just throw their hands up and say, I'm not even going to try to figure that out. All right, let's move on to our second map. This one is all about spin-offs. This is when a big parent company gets rid of one of its smaller businesses, not by selling it, but by just giving the shares away to its own shareholders. You can think of these as corporate cast-offs. And why would a company do this? Well, the reasons usually aren't very glamorous. Maybe the business is a dud that's dragging down the parent company's stock price. Or maybe it's too complicated. Or it's facing some ugly lawsuit. Basically, the parent company is just trying to get rid of a headache. Now this right here, this is the secret sauce. This is what creates the bargain. You have this perfect storm of selling. The original investors get shares in some company they've never heard of and don't want, so they sell. The new company is often too tiny for big pension funds, so they have to sell. Index funds, if it's not in their index, they're forced to sell. It's just massive forced selling that has nothing to do with value. Let's look at a real-world example. Interton. It was a spinoff from Tandy Corporation. Its book value, basically what the company's assets were worth, was about $15 a share. But because of all that forced selling we just talked about, the stock started trading at only $11, a huge discount right from day one. So what happened? For those patient investors who saw the value everyone else was ignoring, a few years later, that $11 stock peaked at over $62 a share, an absolutely staggering return that was created purely by institutional neglect. All right, for our final map, we're looking at what are called special situations. These are opportunities that pop up because of specific corporate events, things like takeovers or mergers, where the outcome depends more on the deal itself going through than on what the stock market is doing that day. Now, it's really important to get a definition straight here. Classic arbitrage is risk-free, but what we're talking about, risk arbitrage, definitely is not. You're making a bet that a deal that's been announced is actually going to happen. If the deal goes through, you make a nice quick return. But if it falls apart, you can lose money. A fantastic example of this happened right after the historic stock market crash in 1987. There was this company, Becker Western, that had a takeover offer on the table. But the panic and chaos in the market created this incredible opportunity for people who were paying attention. Now, the offer wasn't simple. It was a whole complicated package of cash and notes and other weird securities. I mean, it would make your head spin. But if you did the math and added it all up, the whole package was worth around $14.25 per share. But here's the kicker. This is the definition of a margin of safety. In the middle of that market crash, you could buy Bettercore's stock for under $10. That's not just a discount to the full deal. It was less than just the cash part of the deal. Your downside was almost zero, with a clear path to a 40+% return if the deal just closed like it was supposed to. So as we kind of wrap things up here, what's the one thing that connects all of these ideas? Liquidations, spin-offs, messy merger deals, they all create these amazing bargains for the exact same reason. They take advantage of predictable patterns in how people and institutions behave. Our fear of things that look complicated, our desire to avoid things that look messy, and all those rigid institutional rules that force selling at the worst possible time. And really, that leaves us with one final question for you to think about. The company names change, the deals look different, but that basic human behavior, it never changes. So where are today's unloved assets? Where are the corporate cast-offs and the complex situations that are creating the huge bargains of tomorrow? The treasure hunt, well, it's always on. Thanks for watching. You know, what if you found a vending machine that gave you $1 back for every 50 cents you put in? Sounds totally impossible, right? Well, what if I told you that a huge crisis in the financial world created a situation that was pretty much just like that? Today, we're diving into thrift conversions, a really unique moment in history where some very smart investors could basically do just that. Let's get into how they pulled it off. So let's really think about that for a second. What if you could buy something you knew for a fact was worth $20 for just 10, and not, maybe in the future, but right then and there at the very moment you bought it? It sounds like a cheat code for the market, doesn't it? But believe it or not, in the chaos of the 1980s, a very real opportunity made this possible. Okay, so to understand how this was even a thing, we have to go back in time to the world of thrift institutions. You might know them as savings and loans. For decades, these guys were the sleepy, super stable backbone of American homeownership. But a perfect storm of events was brewing, and it was about to turn their quiet little world completely upside down. Yeah, there was this old joke in the industry that just captured their business model perfectly. It went, take deposits at 3%, lend them out at 6%, and be on the golf course by 3 o'clock. It was simple, it was profitable, and yeah, maybe it was a little boring. But this whole comfortable world was built on a set of rules that were about to be totally shattered. So how did it all fall apart? Well, it kicked off in the late 70s with deregulation. All of a sudden, thrifts had to pay much higher, fluctuating interest rates to get people to deposit money. Now here's the problem. All their money was locked up in these old, 30-year mortgages earning a low, fixed rate. Just imagine your own costs suddenly doubling while your income stays exactly the same. That's the deadly negative spread that started crippling them. So, in '82, a new law tried to help by letting them make riskier loans to try and catch up. But for a lot of them, this was like throwing gasoline on a fire. Those risky bets blew up, and it led to a full-blown crisis with billions and billions in losses. But right in the middle of this firestorm, the most conservative, the best-run thrifts, they had an escape hatch. They could convert from their old-fashioned ownership structure, where they were technically owned by their depositors, into a modern company owned by shareholders. This was huge, because it allowed them to raise the fresh cash they needed to not just survive, but actually thrive. But listen, this was not just any IPO. A thrift conversion had this really unique twist in its math that created that incredible $20 for 10 opportunity we talked about. It just completely flipped the script on how public offerings normally work. And this slide right here shows the magic perfectly. Okay, in a typical IPO, you've got insiders who get in early at a super low price. Then, when the public buys in, their money gets diluted. So you might pay, say, $11 for a share, but the actual underlying value of the company per share, its book value, is only $6. The public instantly loses, and the insiders get a huge windfall. But a thrift conversion, it was totally different. There were no insiders with cheap shares. If a thrift already had $10 million in capital and then raised another $10 million from the public, that new money was simply added to the pot. So you paid $10 for a share, and you instantly owned a piece of a company with a book value of $20 per share. You literally doubled your money on paper the second you bought in. So here's the crucial point, the real aha moment. When you invested in one of these thrift conversions, you are basically getting the entire pre-existing profitable bank for free. You put your money in, it got added to the bank's capital, and you got a claim on both your money and all the money and assets that were already there. It's an incredible setup. The process itself was pretty straightforward. First dibs on buying shares went to the people who already had their money in the bank, the depositors. That makes sense. Management could also buy in, and then whatever was left over was offered to the general public. And check this out. This is another detail that should make any investor's ears perk up. Unlike a normal IPO where the founders are often looking to cash out, here the management team was buying shares right alongside the public at the exact same price. They were putting their own money on the line, which is the ultimate signal that they truly believed in the value, even before you had to invest a single dime. Now, this all sounds great in theory, but let's look at a real-world example to see how this actually played out. We're going to look at a company called Jamaica Savings Bank, which was a true diamond found right in the rubble of the thrift crisis. Okay, I want you to just picture the scene for a second. It's 1990. The news is saying the thrift industry bailout could cost up to $500 billion. Real estate is in an absolute freefall. Banks are being seized by regulators left and right. And right in the middle of all this panic, Jamaica Savings Bank announces it's going public. I mean, the timing could not have possibly seemed worse. But if you actually looked past the panic and read the fine print, you'd see this was no ordinary thrift. Its capital-to-asset ratio, which is a key measure of a bank's safety cushion, was a staggering 13.5%. This meant it was one of the most overcapitalized, rock-solid, fortress-like banks in the entire country. And get this, look at what its assets were made of. While all these other thrifts were drowning in bad real estate loans, 2/3 of Jamaica Savings Bank's assets were in ultra-safe cash or U.S. Treasury bonds. They had virtually no business risk at all. And the price, because of all the panic in the market, this fortress of a bank was being offered to the public at just 47 cents on the dollar of what it was actually worth. Just an unbelievable, incredible discount for a business of this quality. And management knew it. They weren't just sitting on this cash, they were practically screaming from the rooftops what a bargain their own stock was. They told investors, straight up, that they would use the money from the IPO to aggressively buy back their own stock at these depressed prices, a move that would instantly boost the value for every single new shareholder. So let's zoom out from this one example. The story of thrift conversions offers some really powerful, timeless lessons for any investor. It just goes to show you the edge you can get by thinking for yourself and focusing on fundamental value, not headlines. So how did investors find these gems? Well, they followed a pretty clear playbook. They avoided complexity. They stayed far away from thrifts, making risky loans they couldn't possibly understand. They focused on repeatable, high-quality earnings, not smoke and mirrors. But, and this is the most important part, they did their own homework. They analyzed each company individually instead of just getting swept up in the widespread panic. And this quote right here, it really gets to the heart of why this opportunity even existed in the first place. The market was in such a panic about the thrift industry that investors just painted every single company with the same brush. They threw the good out with the bad, and they totally failed to see the huge difference between a fortress like Jamaica Savings Bank and all of its failing peers. And that brings us to the single most important lesson from this whole story. The biggest opportunities, they aren't found in hot, popular industries that everyone is talking about. They're found in the rubble of a crisis, in areas that are ignored, misunderstood, and frankly feared by the crowd. Look, the specific thrift conversion opportunity might be a thing of the past, but the principle behind it is more relevant than ever. The herd mentality is always with us, right? It's always creating these pockets of fear and misunderstanding in the market. So the real question this history leaves us with is this: where is today's rubble? What out-of-favor industry is everyone ignoring right now, where another diamond might just be waiting to be found?
Welcome to The Explainer. Today, we're diving headfirst into a world most investors run away from: the complex, often messy, but sometimes incredibly profitable world of investing in financially troubled companies. Let's just be real for a second. The words distress and bankruptcy, they don't exactly scream great investment, do they? They bring up images of failure, of businesses shutting down. For the vast majority of people, it's a huge red flag, a clear signal to just stay away. I mean, the whole thing just seems complicated, risky, and like way too much work.
And that, right there, is the question every value investor lives for. You see, it's precisely because so many people are either unwilling or unable to do the hard analytical work that the stocks and bonds at these companies can trade for pennies on the dollar, way below what they might actually be worth. This fear creates a really unique situation for anyone who knows how to sift through the wreckage.
So, here's our game plan for today. We're going to look at how companies get into this mess in the first place, what choices they have, what bankruptcy protection is really all about, and then we'll get into the investor's mindset, how they spot value. And of course, we'll wrap up with the big risks and some really fascinating real-world stories.
All right, so first up, how does a company even end up on the edge of a cliff? Trust me, it almost never happens overnight.
What's really interesting is that it almost always boils down to one or maybe a combination of these three things. You've got operating problems, maybe their core business just isn't competitive anymore. You've got huge legal troubles, like the massive asbestos lawsuits that took down giants. Or, and this was a big one in the 80s, you simply have a company that took on way too much debt.
And once that first crack appears, it can trigger this terrifying downward spiral. As soon as word gets out that they're in trouble, their suppliers get nervous. They start demanding cash on delivery, which, just makes the cash problem worse. Then customers who need long-term support get spooked and start looking elsewhere. And finally, your best employees see the writing on the wall and start jumping ship. It's a brutal feedback loop that can really speed up the decline.
Okay, so the walls are closing in. Management has to make some really tough calls, and generally, there are three main paths they can take. And this really lays out the dilemma perfectly. Path number one, try to tough it out. Slash costs, sell off parts of the business, do whatever you can to stay afloat. Path two, go to your lenders and try to negotiate a deal. Maybe swap their old debt for something new that's easier to handle. Or path three, the last resort, file for Chapter 11 bankruptcy protection.
Now that second option, the exchange offer, is fascinating. It's a classic prisoner's dilemma from game theory. So imagine you're a bondholder, and the company offers you, say, 70 cents on the dollar. If everyone accepts, the company probably survives, and everyone gets a decent outcome. But here's the catch. What if you accept, but a bunch of other guys hold out? The company might just scrape together enough cash to pay the holdouts in full, and you're left holding the bag. This fear, this incentive to be a free rider, makes these out-of-court deals incredibly hard to pull off.
So to solve that free rider problem, Wall Street came up with a really clever solution, the pre-packaged bankruptcy. Basically, the company gets the majority of its creditors to agree on a full restructuring plan before they even file for bankruptcy. Then they take that pre-approved plan to the court, which can then legally force the handful of holdouts to go along with it. It's the best of both worlds, the speed of a private negotiation with the legal power of the bankruptcy court.
All right, so what happens when all those other options fail and a company has to file for Chapter 11? Well, for many, it's not the end of the road. It can actually be the start of a comeback.
The second a company files, it's like a legal shield comes down around it. It's called an automatic stay. All lawsuits, all collection calls, they just stop. The company even gets to suspend interest payments on most of its debt. This gives them critical breathing room, a timeout, to stabilize the business, figure things out, and negotiate a real plan to get back on their feet. And during this time, something kind of counterintuitive happens. Since the company isn't paying out all that interest, and they've usually cut costs to the bone, they start to pile up a massive amount of cash. Some people call this the money market theory of bankruptcy. And this cash hoard makes negotiating way simpler. Why? Because you can argue all day about what a factory is worth in 5 years, but nobody argues about the value of a dollar. Cash becomes the common language everyone can agree on. Okay, now for the main event. Let's switch gears and put on our investor hat. How on earth do you find an opportunity in all this chaos? Honestly, the whole investment process comes down to these two really fundamental questions. First, how big is the pie? You have to figure out what the entire business is actually worth as a living, breathing company. And second, how is that pie going to get sliced up? You have to dig into all their debts and figure out who gets paid first, second, third, and so on. And slicing that pie isn't a free-for-all. There is a strict legal pecking order, known as the absolute priority rule.
At the very top, you have secured lenders, like banks that have collateral. They get paid first. Then come the senior unsecured creditors, like most bondholders. Below them, you find subordinated debt. And way down at the bottom of the list, if there's anything left at all, are the stockholders. This rule is the absolute bedrock of the entire system. It brings order to the chaos and lets investors figure out where they stand. The legendary investor Michael Price actually broke down the timeline into 3 stages. Stage 1 is right after the filing. It's pure chaos. Nobody knows anything, and you see a ton of forced selling. The risk is massive, but so is the potential reward. By stage 3, a reorganization plan is pretty much set in stone. Most of the risk is gone, and the investment starts to look more like a simple arbitrage trade with a much more predictable but smaller return.
Now, obviously, this type of investing is not for the faint of heart. The risks are very, very real. But some of the real-world examples show just how incredible the opportunities can be. First thing to remember is that not all bankruptcies are created equal. On the low-risk end of the spectrum, you might have something like an electric utility. Yeah, it has too much debt, but it's basically a monopoly and people are still going to turn on their lights. The business itself is stable. On the complete opposite end, you've got a struggling fashion retailer. Their main asset is their brand, which can be destroyed by a bankruptcy filing. That's a much, much riskier bet.
So let's look at a cool example. Harcourt Brace Jovanovic. This company was once a star in the junk bond world. But then, after one bad deal, Wall Street's entire perception of the company just shattered. The company's total value dropped by over 2/3, almost overnight. This was all about sentiment, about panic. It created a crazy situation where their bonds were trading for 25 cents on the dollar, even though a calm analysis showed they were probably worth at least 60 to 90 cents.
And this next one, this is where things get just plain weird and totally illogical. Back in 1990, the Bank of New England was in serious trouble. Its bonds, which remember are senior and get paid first, had a total market value of under $100 million. At the exact same time, its common stock, which is junior and gets wiped out if the bonds aren't paid in full, was trading at a market value of $250 million. Think about that. The market was saying the claim on the penthouse was worth more than 2 times the claim on the entire building. It makes absolutely no sense.
So for a smart investor, this was a screaming signal. It created a perfect arbitrage opportunity. You could buy the dirt-cheap senior bonds and at the same time sell short the ridiculously overpriced stock. If the bank failed, the stock would go to zero, giving you a huge profit on your short to offset losses. If the bank somehow survived, the senior bonds were almost guaranteed to go up way more than the stock. It was a trade based on pure market insanity.
And this really gets to the absolute heart of the matter. The best opportunities here don't just exist because a company is cheap. They exist because of how other people are forced to behave. You have big institutions whose rules require them to sell a bond the second it gets downgraded, no matter the price. You have other investors who are just too scared to touch anything with the word bankruptcy on it. It's this forced, emotional, uneconomic selling that creates the bargain for the investor who's willing to do the work.
You know, it's pretty ironic when I think about it. A lot of the same people who fueled the junk bond craze in the 80s turned around and became the experts in cleaning up the mess in the 90s. It just goes to show you how markets move in cycles. And that leaves us with one last big question to think about. Where is the stigma today? What market are most investors ignoring out of fear or complexity right now? And could that be where the next great wave of value opportunities is hiding?
Welcome to The Explainer. Today, we're going to crack open the playbook of professional value investors to really understand how they manage an entire portfolio. We're going to break down the key strategies for building, protecting, and of course, profiting from your investments over the long haul. Okay, so here's the game plan for today. We're going to start with the core philosophy, this idea that managing a portfolio is a never-ending game. Then we'll build up our defenses, talking about liquidity as your safety net and how to build a resilient portfolio. And from there, we dive into the heart of value investing, having a price-driven mindset and mastering the actual art of the trade.
You know, this quote right here, it just perfectly sets the stage. See, unlike a project that you can finish and walk away from, investing is this continuous, relentless process. You never really arrive. You are always managing, always reassessing, and getting that shift in mindset is it's absolutely fundamental if you want to succeed long-term. Okay, let's jump right into our first section. This isn't about scoring a few quick wins here and there. It's about learning to manage a complex system that is always, always in motion.
And this is such a key distinction to make.
I mean, you could own a piece of a fantastic, stable business like Heinz, right? But that doesn't mean you're guaranteed a stable return. And why is that? Well, it's because your return isn't just about how well the business does. It's completely determined by the price you paid for its stock. The market's wild mood swings are a variable you just always have to deal with.
Okay, so if returns are so unpredictable, how do you even begin to protect yourself? Well, that brings us to the absolute bedrock of any solid portfolio defense: liquidity. You can think of it as your strategic escape hatch, your power to react, and maybe most importantly, it's the power to change your mind.
And this chart just lays it out so perfectly. Look, if you buy a liquid stock like IBM and it turns out your whole idea was wrong, you can sell it and move on. Yeah, maybe you take a small financial hit, but that's it. But if you're stuck in an illiquid limited partnership, you are locked in. You literally cannot change your mind. And that inability to correct a mistake is a trap that investors almost always end up regretting.
So what's the takeaway here? It's all about finding that sweet spot, that right balance. Of course, you don't want a portfolio that's 100% cash. You'll never earn a thing. But you absolutely, positively have to avoid being 100% illiquid. You need that flexibility, that dry powder, to defend against whatever crazy thing happens next and to pounce on new opportunities when they show up.
But you gotta be careful, because liquidity, well, it can be a total mirage. Just because a stock is super popular and trades in high volume today doesn't mean it will tomorrow. When the market panics, or when a hot trend goes cold, that liquidity can just vanish. It evaporates in an instant, because everyone is stampeding for the same tiny exit door at the same time.
And man, this quote from Louis Lowenstein just nails it. Think about it. For every seller, there has to be a buyer. So sure, any one person can probably find a buyer and get out, but the entire market can't sell at the same time. And that's exactly why liquidity disappears in a crisis. All the buyers just run for the hills.
You know, a really powerful way to think about this is to see your portfolio as a cycle. It starts as cash, it becomes an investment, and eventually it turns back into cash when you sell. This process, it has this kind of cleansing, cathartic effect. It forces you to constantly be on the hunt for the absolute best new opportunities, and it keeps you from getting complacent and just holding on to old, deadwood investments. All right, so we've got our safety net of liquidity. Now let's add the next layer to our portfolio defense. How do you actually structure your holdings so they can withstand those storms that you know are coming? Well, this is where diversification and hedging come into play.
So how many stocks do you actually need? Well, the number might surprise you. For prudent diversification, we're talking about maybe 10 to 15 different securities. That's often more than enough to protect you from the risk of any single investment blowing up and sinking your entire portfolio.
But here's the thing, and this is so important. You have to avoid what you might call the index fund mentality of just diversifying for the sake of it. I mean, owning hundreds of stocks means you inevitably end up owning your 100th best idea. The value approach argues it's way, way better to concentrate your money on your very best ideas, the ones you know inside and out.
And this is such a great warning, right? Diversification is potentially a Trojan horse. You can't just substitute diversity for good judgment. A portfolio with 100 different overpriced, super risky junk bonds is not diversified and it is not safe. No, it's just a highly risky portfolio of junk. True diversification is about owning different kinds of assets whose risks don't all move in the same direction. So beyond diversification, which handles company-specific problems, you have hedging. Hedging is all about protecting yourself from those big market-wide risks. And you can actually tailor the hedge to fit what you own. For example, if you have a bunch of large stocks, you can hedge with S&P 500 futures. Or if you own gold miners, you could sell gold futures to protect yourself. But look, we got to be crystal clear about this. Hedging is a strategic tool. It's not something you do all the time. Hedges can be really expensive, they can be complicated, and you should only use one when the risk you're worried about is massive and the price of that protection, the cost of the hedge, is actually reasonable. Overpaying for safety is in itself a bad investment. Okay, so we've built our defenses. Now we get to the fun part, the offense, the very heart and soul of the value investing philosophy. And it all comes down to one thing, just one single powerful factor: price. And this chart just lays out two completely different worlds, right? On one side, you have the company-driven investor. They get all excited about a good story, a hot new technology, a trendy industry, and then they decide to buy. The value investor does the exact opposite. They don't wake up in the morning knowing what they want to buy. They scan the market for bargains, and it is the price that dictates their actions. So what is trading in this world? It's not about jumping in and out of stocks every 5 minutes. No. It's the disciplined, patient process of capitalizing on the market screw-ups. When other people panic and sell things for way too cheap, you buy. When they get greedy and bid prices up to the moon, you sell. You are the rational player in what is often a totally irrational game.
Okay, so that's the mindset. But how does this actually work in the real world? I mean, how do you buy? When do you sell? Let's get into the practical side of things. Okay, here's a really powerful buying technique that pros use all the time. Let's say you found a bargain. The key is to never go all in at once. You buy a partial position, which means you keep some cash reserves. You keep your powder dry. If the market keeps being irrational and the price drops even more, you see it as a gift. You can then average down, buying more shares at an even better price.
All right, now let's talk about selling, because this is where so many people go wrong. They rely on these rigid, totally senseless rules, selling just because a stock hits a certain PE ratio or because you've made a 50% gain. That ignores the only question that actually matters. Is the stock still a good value? And using a stop-loss order is even crazier from this point of view. It literally forces you to sell after the price has dropped, which is exactly when a value investor might want to buy more.
I love this quote, especially when you're dealing with stocks that don't trade a lot. You have to feed the birdies when they are hungry. It's a great reminder that selling isn't just about your personal assessment of value, it's about market reality. You can't sell if there isn't anybody there to buy. So when buyers do show up for an illiquid asset, you have to take that opportunity seriously because they might not be there tomorrow. So I want to leave you with this one final thought to ask yourself as you manage your own investments day to day. Are my actions being driven by a disciplined assessment of the real underlying business value, or am I just reacting to the headlines, to the fear, to the greed, to all the chaotic noise of the market? The answer to that question will define your results.
So how do you invest your money when you know you can't do it all yourself? Look, for most of us, being a full-time investor just isn't in the cards. It's got to be a side gig, if that. So what are your alternatives? Let's dive into a real guide for making that incredibly important choice. Okay, let's start with a pretty stark quote from our source material, the book Margin of Safety. It makes a really blunt point. The options out there for regular people, well, they aren't always that great. And that's exactly why doing your homework, your due diligence, isn't just a nice idea, it's absolutely essential. Here's our game plan for today. We're going to start with the core problem every investor faces. Then we'll try to navigate the maze of mutual funds. After that, we'll get into the nitty-gritty of how to pick a professional, from checking out their character to really understanding their performance. And it all leads to that final decision, which you'll see has to be rooted in your own philosophy. So what is this fundamental dilemma we're talking about? It's actually really simple. Successful investing isn't some weekend hobby you can just pick up. It is a full-time job. I mean, think about it. The amount of information, the complexity of the markets, a part-time effort just doesn't stand much of a chance in the long run. Now, this doesn't mean you have to become a Wall Street pro, but you do have to make a serious, ongoing commitment. And if you know you can't do that, well, you need an alternative. All right, so when you decide you need to hand off the reins, you generally have three main paths to choose from. You can put your money into mutual funds, you can hire what's called a discretionary stockbroker, or you can find a dedicated money manager. Each one comes with its own set of promises and, of course, its own potential pitfalls. Let's tackle that first alternative, mutual funds. In theory, they sound like the perfect solution, don't they? But in practice, well, the reality can be very, very different. And just so we're all on the same page, we're mostly talking about open-end mutual funds. They're the most common type. They just issue new shares to investors and buy them back when people want to cash out, all at a price based on what the fund's assets are actually worth, the net asset value, or NAV. And here is where you can really see that big gap between theory and practice. The sales pitch is professional management and easy diversification, but the reality is often just meh. Mediocre performance, a crazy short-term focus, and fees that are based on how much money they manage, not on the results they get for you. So why does this happen? Well, you have to understand the pressures these fund managers are under. Their pay is tied to assets, not performance, so their number one goal is just to gather more money. The fear of you pulling your money out creates this immense pressure to just follow the crowd. Throw in a bunch of hot money from speculators and marketing departments pushing the latest fad, and you've got a recipe for, well, mediocrity.
So if mutual funds can be a confusing maze, what about hiring a pro directly, a money manager or broker? This brings us to what our source material calls the ultimate challenge.
Yeah, this is not like picking a product off a shelf. You basically have to become a detective. Your job is to understand exactly what they do, to really pick apart their approach, and most importantly, to verify their integrity. Now, we need to understand a key concept here: relative performance orientation. This is when a manager's main goal is just to beat a benchmark, like the S&P 500. It sounds good, right? But it often leads them to just copy the index and take risks they shouldn't. The opposite of this is focusing on absolute returns, which means your number one priority is not losing money, period. And that brings us to the most critical part of this whole process, the interrogation. You literally have to be prepared to ask some tough questions to get to the heart of a manager's character and their philosophy. This might be the single most important question you can possibly ask. Are they eating their own cooking? In other words, are they investing their own money right alongside yours using the exact same strategy? If a manager really believes in their approach, they'll have their own skin in the game. If they don't, well, why should you? Next up, fairness. Are all their clients treated the same? Or are the big fish getting special treatment? When they buy a stock, is it allocated fairly across all the accounts? This goes directly to their core duty to you as a client. Now, I want you to step back and just ask yourself, does their strategy actually make sense? Can they explain it to you in a simple way? Our source is a big fan of value investing, but whatever their approach is, it has to be logical. It has to be something they can do over and over again, and it has to be built for the long haul. And we're back to this critical distinction. Are they obsessed with beating the market every single quarter, or is their primary goal to protect your capital and generate reasonable returns over the long term? That focus on absolute returns, that's the sign of a much more prudent, careful manager. Okay, so let's say you're comfortable with their character, you get their philosophy. Now it's time to analyze their track record. But this is way more complex than just looking for the highest number. You have to look behind the numbers. Here is a 4-step process for a proper analysis. First, the time frame. Has their record survived good markets and bad ones? Second, risk. How did they get those returns? Third, you've got to separate luck from skill. Was it just one spectacular home run, or was it consistent good work? And fourth, consistency. Is that winning strategy they told you about still the one they're using today? This is so crucial. A 20% return sounds amazing, but if it came from using a ton of borrowed money or making wild, risky bets, that's not skill. That's a gambler who just got lucky. Returns are pretty much meaningless if you don't understand the risk that was taken to get them. Here are some more specific questions to ask when you're digging into that performance history. You know, the most telling one is often how they performed in down markets. Did they protect people's money? Look for steady results, not wild swings. Ask them straight up if they use leverage. And seeing a manager hold cash can actually be a good sign of discipline. And hey, if their recent record isn't so hot, ask why. It could be that their sound strategy is just temporarily out of fashion. So after all this work investigating funds, a manager's character, their performance, it all comes down to one final decision you have to make. Our source makes a very clear recommendation: adopt a value investment philosophy. That's a risk-averse approach that's all about buying things for less than what they're truly worth. Once you commit to that philosophy, the choice becomes pretty simple. Either find a professional who has a proven track record of mastering it, or commit to putting in the time and doing it yourself. So we're leaving you with the framework, the tools for your own due diligence. You have the questions to ask, you know the red flags to watch out for. The final choice is yours, and it's a fundamental one. Will you invest the considerable time it takes to do this right on your own, or will you invest the effort to find a true professional who actually aligns with your philosophy?